Welcome to Emmy's Climate Finance podcast series, created for institutional investors navigating climate risk. In today's episode, we're looking at the shape of things to come emissions forecasting. Most climate risk analysis projects today's emissions forward unchanged. Our research shows that this systematically distorts forward-looking risk, overstating exposure for companies already reducing emissions, and understating it for those on an upward path. Instead of assuming flat baselines, we use a Monte Carlo Momentum framework to generate probabilistic emissions trajectories grounded in recent behavior. The result is a forward-looking, uncertainty-aware foundation for portfolio-level climate risk analysis. Okay, let's jump right in. I have to say, reading this white paper, the shape of things to come, it felt like a breath of fresh air.
Oh, yeah? How so?
Well, we spent all this time building these, incredibly complex financial models for everything else, for credit risk, for market volatility.
Down to the nanosecond.
Exactly. And then when we get to transition risk, which is arguably the biggest shift of our generation, the default assumption is what? That a company's emissions just stay flat forever.
It is a strange paradox. We call it the flat earth problem.
The flat earth problem. I like that.
Because in any other part of finance, if you walked into a meeting and said, my 10-year forecast assumes a flat baseline, you'd be laughed out of the room.
You would. So why has this been the standard for so long? Is it just that the data wasn't there?
That was a big part of it historically, but there's also a kind of conservatism bias.
Mm-hmm.
The thinking was, if we don't know, let's just assume nothing changes.
But the paper argues that assuming no change is actually a really big active assumption.
It is. It's a distortion because the status quo is almost never static. Things are always in motion.
Right. And this is the part that really hooked me. If I assume a flat line, I'm actually penalizing the companies who are doing the work.
You are. Let's just think about two companies in your portfolio. Company A is going all in on decarbonization. Their emissions are dropping, say, 7% a year.
Okay.
Company B is expanding, building new fossil fuel-powered plants, and their emissions are rising 7% a year.
The flat model treats them as identical risks.
Exactly. It treats them as identical. So you're overstating the risk for the improver.
And maybe making their capital more expensive than it should be.
And you are completely underpricing the risk for the polluter. You're essentially giving them a free pass on their trajectory.
So you're ignoring their momentum.
And in finance, momentum is everything. You'd never look at a stock price today without looking at its trend. It's the same logic.
So if the world isn't flat, how do we predict the curve without, a crystal ball?
Well, that's where this Monte Carlo Momentum framework comes in, the MCM.
Right. Now, Monte Carlo sounds a bit like we're rolling dice in Vegas.
A little, but it's really just a powerful way to simulate uncertainty. Instead of drawing one single straight line forward.
The deterministic view.
Right. You run thousands of simulations based on how the company has actually been behaving recently. It gives you a probabilistic outcome. Think of it less like a single point on a map and more like a hurricane's cone of uncertainty.
Okay, I like that analogy. But any model, any simulation is only as good as what you feed it. And this model seems, really picky about its data.
It is, and for very good reason.
Let's talk about the 2020 cutoff. The model throws out all emissions data from before 2020. My first instinct as an investor is, more data is better. Why ignore a decade of history?
It's a fair question, but in this specific case, more data is not better data. It's actually just more noise.
How so?
The whole world of carbon reporting changed around 2020. Before that, the quality was, let's just say it was flexible. Companies changed their operational boundaries. They used different estimation methods year to year. So if you look at a trend from 2015, you're not really seeing a trend in emissions. You're seeing a trend in accounting.
So you're modeling the accountants, not the smokestacks.
Precisely. It's about data hygiene. Garbage in, garbage out. By starting in 2020, you get a much cleaner signal of how the company operates now.
Okay, that makes sense. The other rule that jumped out was the 3-year minimum. No forecast if you don't have 3 solid years of data.
Yes. And that's a hard rule.
But a lot of providers would just try to estimate or fill that gap.
They would, because everyone wants 100% coverage.
Yeah.
But our philosophy here is that a bad forecast is much more dangerous than no forecast.
Why's that?
Because to establish momentum, which is the rate of change in volatility, the consistency of that change, you mathematically need at least 3 data points. With 2, you just have a straight line. You have no idea if it's a stable trend or a total fluke.
So without that 3rd year, you're just guessing.
You're just guessing. And we'd rather say we don't know than give you a number with false precision.
So we have clean inputs. Let's talk about the engine. It runs 1,000 simulations, but it does it separately for Scope 1, Scope 2, and Scope 3. Why not just model the total carbon footprint?
Because they're completely different animals. They behave in totally different ways.
How so?
Well, Scope 2, your electricity, can be a step change. You sign a big renewable energy contract and boom, it can drop to almost zero overnight.
Okay.
Scope 1 is your direct operations, your fleet, your furnaces. That's much stickier. It changes more slowly. And Scope 3 is your whole supply chain. That's a beast of its own.
So if you blended them all together,
The noise from one could completely drown out the signal from another. You'd lose all that nuance. By modeling them separately, you can see exactly where the risk is coming from.
I want to ask about shocks. Real companies are messy. They buy a competitor, their emissions double, they sell a division, they have. How does the model handle a sudden 100% jump like that?
That's a great point, and it's a key feature. A simple trend line would see that jump and project it forward exponentially.
And you'd get some ridiculous number, like the company's going to emit more than the entire planet in 5 years.
Exactly. So the model has what's called outlier downweighting. It sees a massive structural break, anything over 100%, and it accepts the new, higher level of emissions.
So the new baseline is real.
The new baseline is real, but it heavily dampens the influence of that single jump on the future trend. It understands that just because you doubled in size one year doesn't mean you're going to double again the next.
It separates a one-time event from a continuous behavior.
That's a perfect way to put it.
Now, speaking of avoiding crazy projections, I really like the part on sanity checks. It feels like so many models today they can hallucinate. They give you an answer that looks confident but makes no sense.
Right, and we need to prevent that. There are two main filters that kill what we call zombie forecasts.
Zombie forecasts.
The first is the 3x rule. The model looks out to 2030, and if the predicted range of uncertainty, the standard deviation, is more than 3 times the company's entire historical average,
It just rejects it.
it kills the forecast.
Yeah.
Because that implies a level of chaos that's just not plausible for a functioning business.
And the second check.
The second is the coefficient of variation. It's a bit technical, but basically, if the cone of uncertainty is twice as wide as the median forecast itself,
It's too broad to be useful.
it's like a weather report saying tomorrow will be between minus 50 and plus 100 degrees. It might be true, but you can't make a decision with it. So we say no forecast provided. It protects you, the investor, from acting on meaningless data.
Okay, let's get to what I think is the most fascinating part of this research. We live in this age of AI. Everything is machine learning.
It is.
And yet you ran this experiment, this statistical Monte Carlo model versus random forests, neural networks, all the big AI guns,
Man versus machine showdown, yes.
and the simpler Model 1. How on earth does that happen today?
It really comes down to the kind of data we're working with. AI models, especially deep learning, are incredibly powerful when you have millions of data points to train them on.
Right, big data.
But for corporate emissions, we have what's called a short time series. We might only have 3, 4, maybe 5 years of clean data for each company.
Not enough for the AI to learn properly.
It's worse than that. It overfits. The machine learning model looks at those 4 data points and starts to imagine these incredibly complex patterns that aren't really there. It mistakes the noise for the signal.
So Occam's razor wins. The simplest explanation is the best one.
In this case, it was. On a 5-year training period, the MCM model was just flat out more accurate.
And I imagine there's a compliance angle here too.
A huge one. If you're a portfolio manager, you have to be able to explain your decisions. You can't go to a risk committee and say, well, the black box told me to sell.
The neural net's weighting is proprietary isn't going to fly.
Not at all. With MCM, every step is traceable. It's transparent. You can show the math. That explainability is critical when you're managing other people's money.
Okay, so let's get practical. Let's talk results. Who's easier to predict and who's harder?
The clearest pattern is size. No surprise, really. Large and mega cap companies are much more predictable.
What kind of error rates are we talking about?
For large caps, it's in the range of, say, 7 to 20%, which, for this kind of forward-looking data, is pretty actionable.
But for smaller companies?
For microcaps, that error rate jumps up to 40%, sometimes more.
Why such a big difference? Is it just that the reporting is worse?
It's partly reporting, but it's more about operational reality. A microcap might only have 2 or 3 factories. If one have a maintenance shutdown, its emissions could drop by 1/3 for a whole year.
Whereas for a mega cap, that's just a rounding error.
Exactly. The big companies have so much operational inertia that their path is just smoother and more statistically stable.
So the takeaway for an investor in, say, private equity or small caps is that you need to account for a much wider range of outcomes.
A much wider cone of uncertainty. You can't apply the same level of confidence.
So the big so what question. How do I use this to actually make better decisions? Let's talk about TVaR, transition value at risk.
Right, this is the bottom line. A standard TVaR model takes today's emissions and multiplies them by some future carbon price.
The flat Earth model.
The flat Earth model. But if a company's emissions are actually trending up by 5% a year, your calculation is fundamentally understating the future liability.
By a lot.
Drastically. Using this dynamic forecast gives you a business-as-usual liability that's grounded in reality, not a static fantasy. A company might look cheap today, but when you price in its probable emissions growth, it might actually be very expensive.
But I think the most powerful application is what the paper calls the reality gap.
Ah, yes.
I mean, every investor is just drowning in corporate net zero pledges right now. Everyone's going to be green by 2040 or 2050.
It's in every sustainability report.
It feels like marketing. How does this model cut through that noise?
This is the killer app, in my opinion. You take the company's target, their promise, which is usually this beautiful, smooth line sloping down to zero.
The marketing line.
The marketing line. And then you overlay our MCM forecast, which is the physics. It's what the company is actually doing based on its recent behavior.
And you see if they match.
And very often you see a huge gap. The target says emissions will fall 5% next year. The momentum says they're on track to rise 3%.
That gap, that's the ambition gap.
It's a credibility gap. It's a risk indicator. It tells you that for this company to hit its target, it can't just keep doing what it's doing. It needs a massive structural break from its own past.
It's basically a lie detector for corporate promises.
Or at least a reality check.
Yeah.
And it transforms your engagement. The conversation is no longer just, do you have a target?
The question becomes, your track record says up, your target says down. Show me the plan. How are you going to bend that curve?
Exactly. It forces a much more strategic conversation. Is your target credible?
And it must work in reverse, too. You could find companies with no fancy targets who are just quietly getting the job done.
The silent achievers. The market might be pricing them as a dirty company, but the data shows they are systematically taking risk out of their business year after year. That's where you find alpha.
So we're moving from a world of trust me to show me the data.
That's the whole shift. It's about accepting that the future is uncertain and then using the right tools to measure that uncertainty.
It really feels like we're finally maturing in how we analyze this risk.
We are. The mistake was always trying to pretend uncertainty didn't exist. Once you can actually see that cone of possibilities, you can price it. And pricing risk is what investing is all about.
Fantastic. This has been incredibly insightful. Thank you for walking us through all of that.
My pleasure. It was great to get into the details.
Thanks for listening to this episode of Emmy's Climate Finance Podcast. Emmy creates climate risk solutions for investors. We provide emissions, transition, and physical risk data for every company and investments supporting 100% portfolio coverage across both private and public markets for all asset classes. With our comprehensive climate risk data set, we deliver the transparency and customization needed to power investment decisions, meet climate reporting obligations, and align with investor mandates. Emmy is backed by a team of climate and finance experts, and we believe that properly pricing carbon into financial systems is the fastest, most cost-effective way to accelerate decarbonization. To access our latest research and tools, visit emmy.io. We'll see you next time when we explore more climate risk built for investors.